Welcome back. It's JWalter here, and here's your latest housing market update. I'm actually really excited to share today's video with you guys because so much has changed today. So let's go ahead and dive right into the video. So CNBC is reporting surging mortgage rates push mortgage demand down more than 40% from 1 year ago. This is a little bit deceiving though, because there's a lot more to this story. So let's go ahead and dive right into this report here. So they say rising mortgage rates are crushing the mortgage market as precious few homeowners can now benefit from a refi and more potential home buyers are becoming priced out. So again, for every 1% gain in mortgage rates, that causes a 10% decrease in buyers' purchasing power. So we're seeing some home buyers getting priced out of this housing market. So because mortgage rates have been spiking greatly this year, of course, refinance demand decreased greatly compared to 1 year ago, down 62% from 1 year ago, which is pretty astonishing. And this is according to a new report from the Mortgage Bankers Association. And I'm going to be sharing that report here in just a little bit. In addition, mortgage applications to purchase a house decreased 9% compared to 1 year ago. And because of this volatility of mortgage rates right now, and because they have been spiking so greatly lately, companies like Movement Mortgage and Better.com have been doing layoffs. This is because a lot of mortgage companies went on a hiring spree when mortgage rates dipped to all-time record lows back in 2020. In this article, they said we had more than a dozen record lows, and that caused, of course, a boom in refis as well as purchases in 2020. In any case, because mortgage rates have been spiking greatly, it was announced actually 2 days ago that Movement Mortgage is laying off 170 employees. In addition to that, TechCrunch.com is reporting that Better.com is laying off employees as well. So they say less than 1 month ago, after laying off 3,000 employees, digital mortgage lender, that's keywords there, Better.com is offering its corporate product design and engineering employees 60 days paid severance or voluntary separation plans. Better.com executives cited the current mortgage markets for the move in an email to employees. The reason why I say keywords here, digital mortgage lender, if you're a lender or a loan officer who is dependent on refis, you're going to get absolutely screwed. This is, of course, because mortgage rates have been spiking. And of course, because of that, not a lot of people are doing refinances right now. And I'll share some more news regarding that here in a little bit. It goes on to say in this article here that sources said the company, which is Better.com, is losing around $50 million a month. And by the way, Better.com is the same company that laid off 900 employees via a Zoom call that actually went viral. And that was done by the CEO of that company. So here's the actual report on the Mortgage Bankers Association's website, or the MBA. They actually just posted this today at the time of this video, which is the 6th. They say mortgage applications decreased 6.3% from 1 week ago. And this is for the week ending April 1st, 2022. But if you guys follow the channel, you guys all know that mortgage applications make up refis as well as purchases. So the reason why mortgage applications in whole have been decreasing so greatly is mostly due to a fallout in the refi market. So the refi index decreased 10% from the previous week and was 62% lower from the same week 1 year ago. However, the purchase index also decreased as well. The unadjusted purchase index decreased 3% compared with the previous week and was actually 9% lower than the same week 1 year ago. It says the 30-year fixed rate mortgage increased for the 4th consecutive week to 4.90%. However, mortgage rates are above 5% right now, and I'll share some additional details here in just a little bit. It says as higher rates reduce the incentive to refi, application volume dropped to its lowest level since the spring of 2019 for refis. The refi share of all applications dipped to 38.8%. That's actually down from 51% 1 year ago. They also said, additionally, the elevated average purchase loan size and steeper 8% drop in FHA purchase applications are both from first-time homebuyers being disproportionately impacted by supply and affordability challenges. So the Mortgage News Daily is reporting today that the average 30-year fixed-rate mortgage in the US actually increased to 5.08%. As you guys saw in my video from yesterday, the average reached 5.02%. 1 year ago, we were at 3.34%. That's an increase by 1.74% in just 1 year alone. Now, here's something you should definitely be aware of, and it's also an alarming trend I'm personally seeing. So they say in this report from the Mortgage Bankers Association, the adjustable rate share of activity increased to 6.8% of total applications. That's for purchases and refis. This is an alarming trend because this has been increasing greatly over the past year. So have a look at this. I actually did some research for you guys and looked at the MBA's report from 1 year ago. This is for March 31st, 2021, and this is for the week ending March 26, 2021. So about 1 year ago, that share of activity of ARMs of total applications was only 3.4% of all applications. Now we're at 6.8%. So basically right now, even though we have a low share of activity, it's less than 10%, it has doubled over the course of 1 year ago. So part of the reason why I believe we're seeing more people doing ARMs, and in my opinion, this is very risky because they're only fixed for a set period of time, typically 5 to 10 years, and then the rate becomes variable, and therefore your housing payment also becomes variable. So in my personal opinion, why people are moving to ARMs, or an increasing share of people are, is because the rate on those is less than a regular conventional mortgage or FHA mortgage. So have a look at this. The average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances, that means a balance of $647,200 or less, that is at 4.90%. When you look at FHA, it's also at 4.90%. However, 5-year fixed and 1-year adjustable rate ARMs increased to 3.82%. So right now you can get a 5/1 ARM right now at 3.82% versus a 30-year fixed rate mortgage at 4.90%. Keep this in mind though, those are for rates back in for the week ending April 1st, and mortgage rates have been increasing since then. So right now, the 30-year fixed rate mortgage is 5.08%. An FHA loan is at 4.68%, and then a 5/1 ARM is at 4.05%. So basically you can get an adjustable rate mortgage for 1% less than a 30-year fixed rate mortgage, and that could be one reason why we're seeing more people getting ARMs rather than 30-year fixed rate mortgages. Part of the reason why we're seeing this uptick in mortgage rates right now is because the yield on the 10-year US Treasury note has also been increasing as well. So as of today, which is again April 6th, that yield reached 2.611%. That's the highest rate or the highest yield we've had in over 3 years. And this is causing mortgage rates to increase greatly. On top of all this, the Federal Reserve announced, or actually they released, their meeting minutes from their last meeting. In this meeting, they reached a consensus that they would begin reducing the central bank balance sheet by $95 billion a month, likely beginning in May. And stay tuned on the channel because I'll make a separate video with all the latest details regarding these meeting minutes. If you liked today's video, then please hit the like button. I greatly appreciate that. Also consider subscribing if you haven't done so already. Hope you have an awesome day. I look forward to seeing you on the next video.